Hey, what's up guys? In this video, let's look at the stock of Broadcom and try and figure out whether it's a good investment right now. If you're new to the channel, my name is Dan. I do a lot of stock analysis on this channel. So if you like that kind of thing, hit the subscribe button to check out more videos like this one. Alright, let's get started. Alright guys, so Broadcom is a semiconductor company. You can see all of their offerings right here on their homepage. You know, they offer things like routers, connecting different devices, mainframes. You've got cloud computing and enterprise systems. You've got security, and even have, things like motor drive and control solutions. Now, Broadcom breaks their revenue into two segments. The bulk of it is from semiconductors, but 28% of it comes from infrastructure software. Now, as far as where Broadcom's revenues come from, the bulk of it is from other countries, but you have a little concentration with 33% coming from China and 20% from the US. Now, before we get deep into their financials, let's just have a quick look at their stock. It is up 64% over the past year. If we look at the past 10 years, it's up close to 1,300%. Pretty remarkable performance. Interestingly, unlike other semiconductor stocks, it is priced at just about 17.82 times next period's earnings. That is very interesting because when you look at a company like Nvidia being priced at about 40 times next period's earnings, or Taiwan Semiconductor Company here coming in at close to 31 times next period's earnings, compared to those two, Broadcom does look like a much better deal. They even have, just about a 3% dividend yield. But very often when you see large differences in PE ratios, they do reflect differences in risks and or growth prospects, so we're going to have to look at those closely. Alright, here's a quick look at Broadcom's balance sheet. It's not a pretty picture if you ask me. One thing I don't like to see is that, just about 84% of their assets are long-term. So they're very long-term asset intensive, heavy investment requirement there. They do have a lot of debt. I mean, debt to assets ratio there over 50%. I don't love to see this interest coverage ratio 2.39 there. What that means is, using last year's earnings before interest and taxes, they can only cover their interest expense 2.39 times. That is running it really close. And I really don't want to see what's going to happen when interest rates go up and they still have that debt and they have to refinance it at high rates. That would not be good. Liquidity wise, they don't have any pressing concerns there. I mean, current ratio close to 2, quick ratio 1.7. They're in fine shape for liquidity, but long term, I definitely have solvency concerns about Broadcom here. Here's a DuPont analysis for Broadcom. So what we're doing is looking at return on equity and breaking into its three parts here. So they have obviously a terrible year in 2016, but afterward I see they have positive return on equity, which is good. It bounces around a little bit. We're going to check out the 2018 year. Better look into that more closely to see what happened. But if you exclude that year, you have, pretty low ROE. They don't have that much debt except, recently they put on more. So the equity multiplier is not really driving it. They have, fair margins, not really amazing, especially for their industry. I'm not very impressed with that. The positive is that gives them an area they can improve upon. Asset turnover, other than the first year, it's pretty low. Asset turnover tells you how much sales you're able to generate for a given level of assets. So for them, for every dollar of assets they have, it looks like they can generate between 35 and 45 cents of sales every year. So that gets back to their balance sheet. They're very long-term asset intensive. It takes a lot of assets for them to generate revenue. And, I don't like to see that. So overall, it's not a company that I really want to own. But I don't know, I will buy it if the price is right. Alright guys, I said I would check out the 2018 fiscal year to see what happened there. What we have here, to generate that unusually large profit margin there of 58.8%, we have a negative income tax expense. So this happens sometimes where you get, a tax refund to make up for some lost years you reported earlier or something like that. Maybe you had a net operating loss carry forward. It's not the type of thing that's expected to continue. And so that's what generated that ridiculous profit margin. If you want a more stable sense of their profitability, I would look at the operating margins here. And you can see it's a lot more stable, although still fluctuating. It can get up to 27% some years and just about 14 or 15% in other years. Here's Broadcom's dividends and share buybacks over time on a per share basis. You notice in red I have buybacks, and you also notice they're negative in these 3 years. That means they were net issuers of their own stock in those years. That's not something you like to see. That's dilution of ownership there. But dividends, yeah, they've had a great record. $2.52 per share in 2016, up to $13.35 per share most recently. That's just ridiculous, and that's one reason people are very interested in owning Broadcom stock. Here's a few more details about Broadcom's dividends. Yeah, they've grown them for 9 straight years. The 5-year growth rate is 52% per year. Absolutely ridiculous. But you gotta look forward, and going forward, you gotta think about this. It's yielding 3%, and the payout ratio is about 54, close to 55%. So are they going to be able to continue that type of growth or even close to it? Probably not. It's going to depend on their projected revenue growth and growth in margins. So let's have a look at that. Alright guys, so what we're looking at here is revenue growth in millions over time, and on the left I have reinvestments in millions. And you'll see how these two charts kind of help explain each other. So on the right, you notice that revenues went from about $2.3 billion in 2011 all the way up to $23 billion most recently, a tenfold increase. What's really been driving those revenues is acquisitions. As you can see here, they spend very little on capital expenditures. They spend some on R&D, but their large reinvestments are net acquisitions in purple. What I find interesting is that they spent roughly $15 billion on acquisitions in 2019. I imagine we haven't seen the after effects of that just yet. I think that should help revenues for a long time to come. Interestingly, when I look to the future here, looking at analyst forecasts, I don't really see tremendous revenue growth forthcoming. You notice the revenue is estimated to grow by about 10% year over year going into 2021. But afterward, analysts are predicting just about 4 or 5% growth for the next couple of years. And these estimates are not very dispersed. In other words, there's not a lot of variability in the estimates. You look at 23 analysts forecasting for 2022. The low estimate is about $26.5 billion. The high estimate is close to $28.5 billion. So, analysts are pretty certain about this. You can expect not much growth for the next couple of years. Alright guys, at this point in the video, it's time to use intrinsic valuation to try to value the stock of Broadcom. I'm going to use the free cash flow to equity model. Now, to make this model work, I need to make several assumptions. One thing I need to do is assume some kind of discount rate or required rate of return. Now, given Broadcom's balance sheet, given the competitiveness of the semiconductor industry, I'm going to go with the higher rate. I think at least about 8% would be fair. I wouldn't blame anybody for going with 10%. Next, I need to forecast those free cash flows. Now to do that, it's going to be a process. I'm going to walk you guys through it. But we're basically going to start with revenue estimates and go from there. So let's get into it. Alright guys, so here's my vision for Broadcom. I took analyst revenue growth forecasts and plugged them in here. After the third year, we really don't have any guidance from analysts, so I went with a bit more conservative approach and just said, okay, Broadcom will continue to grow at 5% after that, up to year 10. That gives me a stream of revenue. Now to get from revenue to net income, I need to know what is my profit margin. And so, historically, if you look at the averages there, Broadcom in the past 5 or 7 years has had an average net income margin of 18.2%. So I plugged that in. But I also assumed, and this is a little bit less conservative, I assumed that margin would expand, growing by 2% per year all the way till it gets to year 7, where it tops out at about 30.2%. That kind of margin is more in line with the industry, so I'm just assuming Broadcom can get there. If that is true, then this is what their net income is going to be for the next 10 years. To get from net income to free cash flows to equity, I had to subtract some kind of reinvestment. Growth is not free here, so if I assume they're growing at 5% per year, that means they're going to have some level of reinvestment. Some money they make is going to have to go back into the company. I went with a rather low rate because they really don't do any CapEx, and they do acquisitions randomly. You can't predict when they'll be, but I kind of smoothed it out and said 10% per year. That gives us a stream of free cash flows to equity. Let's see what the fair value of the company is given this stream of cash flows. Alright guys, so here we have that stream of free cash flows to equity up to year 10. Afterward, we have a terminal value. I'm just assuming they can grow free cash flows at 2% per year every year after that. If we do that and we discount these cash flows back to present value using an 8% discount rate, we have a total firm value consisting of these three components: cash on hand, the present value of the cash flows over the next 10 years, and the present value of the terminal value. That adds up to be about $137 billion, meaning each share would be worth about $338.93. Now, unfortunately, this is far less than what they're trading at right now. Okay, guys, so what would make this a good deal? It's pretty hard for me. When I look at this spreadsheet, I'm being pretty generous with the reinvestment rate already. I'm not having them reinvest very much. I think I'm being pretty generous with the margins. I mean, the company's margins last year were 12.4%. I have them jumping all the way to 18% and then increasing thereafter to get to 30%. Revenue growth, I could be more optimistic on that front. But when you look at it in total, I'm already being pretty optimistic. I'm even giving them an 8% discount rate. I think some people might opt for a 9 or 10% rate here. So to me, it's clearly not a good deal. Here is the insider trading activity for Broadcom. And you can see there are a lot more insider sales than buys. When you look at the number of shares involved, the picture becomes pretty clear. The insiders are selling the stock in droves. So to me, it's a pretty negative signal. Alright guys, so here are my final thoughts on Broadcom and investing in companies based on PE ratios in general. First thought is to hit that like button. Gotcha. Okay, seriously though, you can learn very little from just a PE ratio. And I think this analysis illustrates that. Because at first you're looking at Broadcom, you say, okay, PE ratio of 17.8, 3% dividend yield, looks a heck of a lot better than their competitors like Taiwan Semiconductor or Nvidia or even AMD, companies like that. They're trading at like 40 or 50 times next period's earnings. However, when you really consider the fact that the PE ratio is a function of growth and risk, everything becomes clear. This company is discounted for a reason, and they should be discounted more. they are not growing at the pace of their competitors, not nearly. They're not growing very much at all. And as far as their risk, they have a much worse balance sheet compared to their competitors. So all things considered, Broadcom is kind of a PE ratio trap, kind of a dividend growth yield trap. 3% yield. They've grown at 50% per year for the past 5 years. Looks excellent, but don't get caught up in the past. Think about the future. Think about where their payout ratio is right now. It doesn't have a lot of room to climb up. And so, to me, it's clearly not a good deal. I'm not going to go for it. But again, that's just my opinion. Let me know what you guys think in the comments below. Thank you for watching.